Hi and welcome back to Property Insight. My name is Mark Ashworth.
I'm Neil Harding.
And on today's video we're just going to give you a little bit of a market update for the 4th of November 2023, and we're going to be talking particularly around the mortgage market, interest rates, and of course a bit about inflation too. So what do you want to hit on first, Nick?
Let's start with inflation. So inflation for the year to September. ONS actual data was announced October 18th, and inflation fell to 6.3%.
Okay.
Which is generally thought of as good news, right? So it was 6.7% the month before. So it's a drop. And The Guardian had reported that inflation was expected to fall to 6.5% in September. And I think that's quite relevant because actually the markets for mortgages, which we'll come on to, they tend to respond to the inflation, not based on whether it's gone down or up, but based on whether or not it's more or less than what everyone thought it was going to do.
Yep.
So it's the gap between expectation and actual that tends to drive any repricing of mortgage products.
Yeah.
So I just think that's quite interesting that it's dropped, but dropped more than, well, at least the Guardian. I'm not saying the Guardian are the only people that have an expectation of what inflation is going to do, but it's indicative. The next interest rate by the change on the Bank of England was the 2nd of November, so just very recently, and they held interest rates at 5.25%. And quite often inflation and interest rates go hand in glove, don't they? Mm-hmm. The Bank of England, of course, are using interest rates as a mechanism to control inflation, which obviously at the moment is very high. So again, what's interesting is they've seen that announcement of what inflation is doing and have decided that another increase is not necessary. So we're going to hold. Hopefully, for those of us who have a leveraged property portfolio, such as us and other investors, which often do have a leveraged mortgage portfolio with, mortgage products are always something that I'm looking at and trying to make sure that you're getting a good deal. That's really relevant information, right?
I think we'll see some interesting movement in the mortgage market. Their fixed rates around 2 and 5 years do tend to be affected by the inflationary rates and the Bank of England holding. That will prove that there is a little bit of settlement there, and I think that will be reflected. Whether it will be reflected this soon, obviously we're doing the market update now only a couple of days after the review for the interest rate, so I think it may certainly trickle through. And I think the other thing to mention is that as we're finding, we've mentioned in a previous video, the mortgage market may see that it needs to be more competitive because of the lack of purchasing, right? So banks obviously want to lend money to people that can borrow it against properties. But if there are not as many properties being sold, and if the market, as far as the purchasing is concerned, is taking a little bit of a hit, I think that there is also perhaps a movement there for the banks to be perhaps a bit less profitable than they were, because they're going to want to lend out, probably keep loading those crazy arrangement fees.
Yeah, the £10,000 arrangement fee that we all love.
Yeah.
I also read an article by Martin Beck, or quoted Martin Beck, Chief Economic Advisor to the EY Item Club. In that, there was a forecast inflation to remain at 6.7% in September, mainly due to the rise in oil prices. He said there would probably be a steep fall in the last 3 months of the year, taking inflation more towards 4%. So that would meet the government's objective of what they've asked for, but obviously still a long way off the 2% target that the Bank of England have. And then, to quote Martin Beck, inflation is now expected to fall slightly faster than was forecast in the summer and could reach 4.5% by the end of 2023 before hitting the Bank of England's 2% target during the second half of 2024. I've got to admit that was a surprise to me, because I hadn't really imagined it would be at 2% by 2024. I've almost become immune to this sort of world of 6% inflation or 5% or 4% Bank of England base rate. So, this is quite interesting. He expects Bank of England to hold rates at 5.25% in November for a second consecutive time. Mm-hmm. And that's what happened. So well done. And begin cutting them next May to help revive what he expects will be a stagnant economy. Possibly stagnant is code for recession. I think it's quite possible there will be a recession in Q4, Q1. Mm-hmm. So watch this space. It'll be interesting to see how that plays out. Let's talk a bit more. You mentioned mortgages, Mark, and how are you finding, have you had conversation with your mortgage broker just recently, or trying to stack deals up using mortgages? How does all that translate into the world of mortgage products?
Well, I probably spent about 6 to 8 months going through a period of, shall I remortgage, shall I not, shall I remortgage, shall I not, based on the fact that mortgages that were around 6 months ago had these, as I alluded to a minute ago, massive arrangement fees. So it's kind of, well, okay, so I can remortgage and get a slightly lower interest rate. I've had a couple of discounted rates, which have obviously over the period have then been increasing in line with the Bank of England base rate. But when you factor in the massive arrangement fee on top, I kind of think, well, it's not making a lot of difference to the interest rate, maybe 1 or 1.5%. So I'll just hold off and wait a bit. And then interestingly, the last 2 remortgages that I've done have been a product known as a track to fix. I've got one now with Kent Reliance and one with Paragon, which is where they'll put you on a tracked rate, but one of them is tracking the base rate, Bank of England base rate, and then the other one is tracking the bank rate. No, sorry, the one that's tracking the base rate is Kent Reliance. The other one, Paragon one, tracks its own bank rate. So obviously they're both subject to change. Obviously base rate is subject to change. The rate with Paragon is subject to Paragon deciding whether they want to change it or not. So it's their standard variable rate, and then it's discounted for a period. I've taken 3-year products on those. One was a small arrangement fee and the other one didn't have any arrangement fee at all. Tracking those rates, at any point during the period of that product, I'm able to switch it to one of their fixed rates by just paying the new product fee for the fixed rate, should I wish to. So that's basically saying, you know, if interest rates do drop in the next 6 months or in the next 3 years at any point, and I want a fixed rate, I can switch onto that without paying an ERC. You just have to pay the new arrangement fee. So I kind of thought, well, you know, I might, because I think I was paying up to about 8% on one of them, and that's gone down now to I think around about 6.24. So it's still higher than getting a fixed rate, but it's got that ability to fix if those rates come down much below 5%. I could have taken a 5% product or a 5.5% product, but the arrangement fee would have been £3,000, £4,000, £5,000 added to the loan, so you're paying interest on it as well. So I've just chosen to take it out the cash flow, the monthly cash flow essentially, rather than adding it to the loan.
Only other thing to add to that is that we've seen a mortgage product from Quantum Mortgages, which is quite an unusual product that's been made available for remortgages for those with either a limited company or property in your own name. It was available for applications from 29th of September onwards. It's only available through a mortgage broker, so they're an intermediary lender service only, so you do have to check your broker, and we would always be advising that anyway. So speak to your mortgage broker about this and see if this product is available at the time when you come to actually applying. The product was available for standard houses, flats, studios and HMOs, as well as single lets. But the key point, standout point about it is that they are allowing for remortgages a 100% ICR or interest cover ratio. So in other words, as long as the rental income is equal to or more than the monthly mortgage interest payment, then they will consider you as being qualified for stress test purposes and therefore eligible to apply. Now, you've got to check this out if this is genuinely the case for you. But
so just for clarity, normally what normal lenders require is if you've got a mortgage in your own name, it's 1.25 times the rental income as cover. And if it's a limited company, it's typically 1.45. Is that correct? Yeah,
it often is. Or if it's a personal name and you're a higher rate taxpayer, I think it might be 1.45 as well. And then some lenders have their own particular nuanced rules as well. But yeah, that's a good rule of thumb, I think. I think the point of this product is that it's being marketed really as, or its target audience, let's say, is for people who are mortgage trapped, buy-to-let investors who are mortgage trapped, and they've maybe reverted to the standard variable rate and maybe they're paying 8, 9, 10% or something, who have maybe even been able to show that they can afford to pay that because maybe they're subsidising at, through other sources of income, maybe PAYE, salaried income or something, but they're mortgage trapped because they can't get off that onto a cheaper rate. This might open up an avenue for those people. So speak to the broker if this is of interest to you. Well, thanks for watching, and we hope this has been insightful for you and look forward to seeing you next time.